John Goodman, Avi Feinberg, and Carl Tricoli come and join James on the stage. Excellent presentation there to set the scene, and thank you, James, for keeping it so enlightening, but also right on point. And if we have any questions rolling on from that, by all means, this is the interactive session where we can pose some questions to the panelists as well. I don't want to dwell too much on my notes. I think what's quite clear, really, is to your first point there, James, we're clearly in a sort of a risk-on environment. And so maybe let's get straight into this around how we're investing throughout. So, John, why don't we start with your view and the view from Dundee at the moment and tackle some of those themes? Is this on, guys? Which mic? Yep.
How about now?
Yeah, there we are. Yeah.
Good, because I didn't want to have to yell. I guess just looking at what we just heard, we don't spend as much time as the speaker does on the short term. We spend a lot more time on the long term. So like the trends that we see is, we look at the U.S. and recognize that, whenever he gets around to lowering rates, it's going to be very good for the gold market, whether it's this year or next year, or even if it's the year after. But the outlook for gold with all of is very positive if you're looking up 5 to 10 years. Same goes for nickel, cobalt, all of the so-called battery metal stocks. And for us, it's not about spending a lot of time talking about the macro that we're here, but it's spending a lot of time talking about the micro, because if you look at mining stocks, and particularly junior mining stocks, they have underperformed dramatically for the last 15 years. We just looked at even the gold market, which is, I'm only using gold juniors because they are much more readily available data. But the reality of it is, if you bought a gold mining company ETF sometime in the middle of the 2010 period and bought it because you liked the price of gold, which by the way was around $650 an ounce then, and said, I think in 2023 gold's going to be at $1,950 to $2,000 an ounce, you would have lost money on that gold company ETF. And if the people think the reason you buy gold stocks is as a proxy for gold, we've got like a 15, 16-year period where it hasn't been. And I think as an industry, we need to do a better job building mines and building businesses and promoting less and actually doing better things on the ground. Otherwise, we're going to lose all investment, and the world needs the investment. So
are things changing? Are we getting closer to, in this new cycle? What's different about this cycle from the last? Are you seeing more positive signs? A slightly wider recognition, things like the Inflation Reduction Act that we don't have to dwell on, but is it changing the mentality enough that people are going to start paying attention to mining? It's going to bring new skill sets.
It'll bring a lot of people in, but unless, as an industry, we do things different, the industry finds a way to make it end in tears. And we got to do things different. I think the reality of it is most of the technical reports you read are crap. We used to joke that if you took Warren Buffett and Peter Lynch and some of the great investors in the world and then put them around a table and said, I'm going to take the best PEA ever written and the worst PEA ever written and hand it to them and ask them to differentiate which one's the good one, which one's the bad one, they wouldn't have a clue. And the reason that's true, and these are really smart guys, is because what makes them good and bad isn't in the document. And as companies, we need to do a better job of proper disclosure, treating our investors as if they're actual owners of the businesses, and having open and honest discussions about risk, which we don't do. I mean, every promoter out there is going to give you the best case scenario for their project.
Yep.
And best case scenario doesn't ever happen in mining.
Yep. No, there's a myriad of risks around the project development, but there must be some good actors. There must be
There's
some
lots
good
of
winners.
good.
There's some success.
I'm here because we make money buying things.
So how are you? Where's your filter at the moment?
It doesn't get lost on me, and it shouldn't get lost on anybody, that every serious transaction in this industry starts with a confidentiality agreement being signed. So ask yourself the question: if all of this disclosure is out there, the resource studies, the feasibility studies, it's all out there in the public domain, why does a professional that knows the industry not make an investment without signing a CA, But yet traditional investors that are actually buying these stocks and buying these securities are expected just to believe everything the company tells them. And so, yeah, we sign CAs and we do lots of deals, and we've done very well over the last few years. But we do it because we actually invest in projects we like. If we're wrong, it's because we've made a mistake, not because someone's promoted us. And I think more investors need to do it. I actually talking against myself by telling that, because it's a great thing to do, because you can actually by bringing in some really good technical prowess, I think we get to know some of these deposits better than some of the companies even know them.
Right, and that's where you're bringing your success. It's on that
That's
technicality.
where we make our
this-
money is by being able to identify really good deposits early and actually working with a lot of the companies we invest in to help them not make mistakes that we've either made or seen others in the industry make over the last 30 to 40 years.
Excellent. Fantastic. Okay, well, look, we touched on some fantastic stuff that I'm going to relay back through the panel. But I'd like to introduce Abby yourself. First time speaking with one-to-one. Thanks for coming along. Different approach. You're less sort of in the detail of the mining company equities as such. But why don't you tell us about what you do with DWS as well? It's because it's interesting to have your fund here involved.
Sure, happy to, and thank you for the invitation. At DWS Group, we manage the physical commodities as well as the underlying equities. So we have a broad commodities fund, we have natural resources equities funds, and we also have gold and precious metals funds that invest in both the physical and the equities. So we're looking across the board. It tends to be larger cap, mid to large cap, but we'll look at a variety of companies. And so we do a lot of work across business cycle analysis and try to think about, a medium-term view, kind of a 12-month out view, and also where we are in the larger secular picture. And I'm, happy to maybe touch on those if that's helpful now.
Yeah, please. Yeah.
So I think that we can separate out our views of the business cycle, the commodity cycle, and then also the secular kind of longer term view of what's changing now versus maybe in past cycles. And I think I'd agree with a lot of Jim's analysis on the business cycle in terms of the risks of higher inflation remaining sticky, in the coming months. There are signs that inflation will come down, but it has surprised many people in how long and how sticky it has remained when you look at core inflation and the underlying drivers there. And even though we see leading indicators that inflation will come down, for now, consumers still have excess savings. If you look since the end of 2019, consumers have saved somewhere on the order of $6 trillion, and at its peak, excess savings were over $2 trillion. Now that has come down a lot since then, and maybe we're somewhere around, under $500 billion. We're starting to see signs that the labor market is softening, and I think that that's going to be important for containing inflation in a way that, where the Fed doesn't have to completely kill the business cycle the way Jay Powell's hero, Paul Volcker, did in the 1970s. So, it's tricky to navigate that. I mean, inflation and the labor market are both lagging indicators, and that's what the Fed is focused on, and as they continue to tighten policy here. And that could induce softness across all assets. That could, we've seen a bid for the dollar. Now it's kind of, it comes and goes, but, a bit of a resurgence when everyone thought it was dead. And generally that's not bullish for commodities in the very short run. In the medium term, and if you zoom out a bit to the commodities cycle, we can see that investment levels are very low. And you look at the CapEx, whether it's in the mining space or in the energy space, we look at agriculture, paper and forestry, oil and gas, metals and mining, and broadly, CapEx levels have only just started to trend higher in the last 1 to 2 years now. And that's, still well off kind of the peak levels if you look back over the past decade, 2012, 2013, when all our junior mining companies were destroying capital, right, in a fierce way. Some of them maybe have hopefully learned some lessons, but I think there are more lessons to be learned. If you look at the in the large cap space, where we follow primarily, a lot of the companies actually are not investing, and shareholders are demanding that capital be returned in the form of dividends and buybacks. Companies have delevered their balance sheets. They are, their free cash flow yields are quite attractive relative to equities. And so I think the companies, by and large, are very well situated to navigate a downturn in the business cycle compared to the past. They're not levered up. They're being cautious. Deals we see are equity funded as opposed to large cash deals, and generally a more cautious approach. Maybe lastly, just so I don't speak too long here on the secular side, I think that it is a little bit different now as we look back, and there are similarities. People want to compare this decade to the 20s, to the 40s, the 60s, 70s, the dot-com bust, and it's true that there are many similarities to these different timeframes. If you look at market history, some of those might be extreme polarization and disparity in wealth and income levels, which we saw in the 20s. Very high asset valuations, again, in the 20s or in the dot-com bust, where tech valuations in particular diverged from the broader equity market. And of course, we have higher inflation now, which you could liken to the 60s or the 70s, depending how you look at it. What's different from those periods, however, is that debt levels are much higher today than they were in the 70s and the 60s. It's actually similar to the 1940s from a debt perspective, where we have wartime levels of finance, and we are running budget deficits of 6 to 7% just in normal times, just to fund entitlement programs effectively. And a lot of that spending is on autopilot. So you saw with the whole negotiations around the debt ceiling, not really that much changed at the end of the day with this agreement. Spending is not coming down dramatically. So demographics are also different. We are seeing that populations are not growing as quickly, in fact, shrinking in many parts of the developed world. So that's particularly an issue in Japan and in Europe. The U.S. is actually relatively well situated there from a demographic perspective. I think what this does is it creates a need to ultimately to inflate large debt levels away through negative real rates, barring some type of productivity miracle. And this could happen, and I'm definitely optimistic that that things like AI and the other investments we're making in the sciences will ultimately bear fruit. But in the near term, it doesn't just all play out at once, and so we have to fund the budget, and that ultimately, if the Fed is forced to choose between financial stability or containing inflation, financial stability comes first every time, and we see that with the recent bank bailouts, where we're kind of easing policy at the same time as we're tightening policy. And I think that's indicative of what could come in the future, where ultimately those debt will be rolled over, and if the buyer of last resort is the Federal Reserve, if the U.S. banking system cannot do that, and ultimately that's going to be bullish for all metals, whether it's precious or industrial metals.
Yeah, I was going to lead on. How is this, everything you've described, how's it channeling your investment strategy into global natural resources? Is there a pivot at this moment, change of strategy? Is it more bullish in terms of real assets?
It's broadly positive for real assets. I think that one thing I didn't touch a lot on was the geopolitics, and I think that we need to be mindful of whether it's a bipolar or a multipolar world that is emerging. We have due to the war in Russia and Ukraine and the U.S. seizing of Russian reserves, there's these countries are understandably working on ways to find alternatives to the U.S. dollar as a payment currency. I think as a reserve currency, that's much harder But even there, the U.S. dollar has, as a share of global reserves, has shrunk from around 73% at the turn of the century to around 60% now. And the BRICS countries are, I think they just had a meeting in Cape Town in late August. They will be meeting again and trying to figure out perhaps putting a currency together. I think that from an investment perspective, that we need to be mindful of where our capital is welcome and where it is also respected. And we see resource nationalism is also on the rise. So many countries, whether it's in Chile, in Mexico, in Indonesia, in Zimbabwe, we see governments being more possessive over resources, wanting to be more involved in the value add nature of extracting more value from those resources. So that creates potential for mining concessions to be changed or to be eliminated in some cases, sales of assets. And maybe you could see more of a premium for assets in places like Australia or Canada or the US as that continues to play out. So ultimately, we want to be in companies that are in good jurisdictions, that have well-managed assets, attractive assets that are low on the cost curve. And, management is going to be critical for all of that.
Okay, excellent. Loads of great stuff covered here. Carl, can I bring you in and maybe get your take on,
That'd be great.
We're creating some excellent opportunities for private equity here with some of these trends that have been described, and what's your take on, the mining companies and the opportunities there? Are you equally as scathing or on the technical analysis that's been provided, or do you have more of a positive view across the sector?
Sure. And is that on? Can everybody hear me? So let me go back to the title and get back to the title of the talk here, which is Green Energy Tailwinds versus Macroeconomic Tailwinds, which will prevail. And I think the answer is both, because what we're seeing right now is, I think you have everything in place for sort of a secular shift based on energy transition and everything that people are familiar with, that you can sort of see that train wreck coming. You see, governments requiring transition or a shift from internal combustion engines into electric vehicles. And you can see along with that the metals requirements with that. That is a sort of medium-term secular shift that's sort of on the way. Right now, what we have are macroeconomic headwinds. I don't think they changed that sort of secular change we're going to see, but right now you've seen metal prices come down about 10% in the last 4 to 6 months. You've seen valuations in mining companies at a point where that's why you're seeing an increase in M&A activity right now and share buybacks, because actually where these companies are trading right now is actually below replacement cost in many cases of where the metals are. And so particularly for the larger companies, it's literally cheaper to go out and buy resources on the street right now than it is to go and put that money in the ground and build mines. And so hence why you're seeing that activity in share buybacks and M&A activity. So in the short term, what you're seeing are lower valuations. You're seeing the macroeconomic headwinds. You look at copper, for example, and where it's come down. We are very constructive on copper in the long term, but you have these short-term headwinds, particularly because China coming out of the lockdown has not re-entered growth as rapidly as people thought they were going to. So we see this as a great investment opportunity right now, depending on your time horizon. But from a longer time horizon, we think this is a great time to invest. Now, we're involved in private equity. Sometimes that involves public companies, but mostly it's private companies. So we are completely focused on the intrinsic underlying value of these assets. And so we sort of see that, the way we create value is sort of in two ways. The first is our capital goes in to develop mines And so there's just an intrinsic value that you get from, taking something that's not cash flowing to something that is cash flowing. But then on top of that, we think there's an overlay of the potential of right-hand skew from commodity price increases, particularly in the energy transition metals. So we try to position ourselves that we inherently make money in the asset just because we brought it into production, but then also focus on those assets where you have a lot of right-hand skew. So, summary is, I think, very constructive for metals prices as you go out based on energy transition. But I think right now we're in a bit of a lull that represents a good buying opportunity.
Yep. And just want to get your take on the opportunities out there, the projects that are out there that you're working through across the tiers. Do you feel that there's some really good quality out there at the moment? Management teams are kind of doing what they need to do despite these conditions that we've described?
I mean, to be honest, there's not a lot of great projects, which I think is what leads us to being so constructive. I mean, there's really two things. The first is there is a complete dearth of capital overall that flows into the mining sector, particularly with junior miners. And so junior miners with projects who require literally multiples and multiples of their market cap in funding to get these projects going, they have no hope of getting that development capital. And there's just not any money flowing in from the public market standpoint, flowing into these companies. And then on top of that, projects are tough. I mean, our best projects right now are in the DRC and in Indonesia, right? I mean, they're tougher places, they're harder projects. And so, we have a list of probably 30 or 40 projects that we follow. But, when you look globally, there's not a lot in the cupboard, to be quite honest, which again translates itself between the lack of capital and the lack of projects, why we are constructive in the medium to longer term.
Yep. Okay, excellent. James, do you have anything to opine on some of the comments that have been shared so far? Yeah. Do you want?
Sure, very, very quickly, because you heard plenty from me earlier. We are just to mention our sort of longer term outlook. We are positive on gold, and whether and again, one of the reasons we're positive on it is because when central banks, when they sold for over 20 years, from 1991 to 2011. And so now that they're buying again, we expect it also to continue for a very long time. Also, as income rises, we expect the levels at which those in the non-OECD world can enter the gold market will continue to rise. But we're just a little shaky about prices up where they are here. But I would certainly, on the green point, that Carl made, we are very positive on platinum, which we see as moving into deficit from a long period of surplus, and the opposite on palladium. After this year, although we're positive on palladium this year, we are bearish going forward because of accumulated surpluses due to substitution in the autocatalytic industry, and also hydrogen and other platinum is used for a lot of other things. And the supply is limited, not because there's not a lot there. There's about 1 billion ounces in reserves in the Dryfontein and other parts of South Africa up into Zimbabwe, but they can't get it out, and partly because of electricity and power shortages. And the point that John made, we are facing the lack of reserve replacement in gold. And, I remember Matt Simmons' book, Twilight in the Desert, Peak Oil. Well, that was absolute rubbish. There's been more oil found in the past 20, 30 years than the world has consumed. A lot of it is on the Iraqi-Saudi border, so maybe not the best place in the world. But what we have is peak gold, and the reserves are dropping at that point. And the only last point on inflation is that to remember that when a portfolio manager, and maybe my friend Avi will support me on this, when you see inflation going up, a portfolio manager, a hedge fund manager, does not buy gold or silver based on that. What he does is he looks to the anticipated monetary response to higher inflation. And if he thinks that means that the Fed or the Bank of England or the Bank of Japan or the ECB are going to raise rates, that will make him sell. And that's why we saw ETF liquidation in the past 15 of the past 16 months, despite a massive gold rally. And just on that inflation topic, I mean, I got asked at a conference, you know, how tight is the US labor market and its impact on inflation? And I said, well, you can look at the data or you can use Jim Steele's labor index. And they said, well, you know, what the heck is that? And I said, well, the fact that my 3 moronic adult sons are all gainfully employed is absolute verifiable and unmitigated proof that we are in an extraordinarily tight labor market. Because if the American labor market was at all under normal circumstances, I can assure you at least 2 of these jokers would be on the door. And I'm waiting for one of them to become, one of them actually has a good job too. And I'm waiting for one of them to become unemployed because that's going to show me that our labor market is finally beginning to soften.
I'll send them the recording from this panel as well. Excellent. That's a good barometer there. Very good. Does anyone have a question for our panelists so far? Anyone want to probe at all? Yeah, let's go down here to start with, and then we'll shoot over there.
Yeah, hi, my name's Russell Katz. Just, you know, we were talking about the macro risk a little bit, specifically on gold. This had been slightly touched on, but can you talk about the potential risk of Russia eventually getting back at least a large portion of its gold reserves that the U.S. is currently holding, and whether that could potentially put some shocks to selling pressure?
Will they be getting it back?
I'm unaware of us holding Russian gold reserves in this country. Physical gold?
Well, I was talking about their foreign, not specifically in the U.S., but that there's a hold on a lot of their foreign reserves.
Yep.
Specifically their foreign reserves.
Yes. I see. I'm sorry. I didn't mean to be. My wife will tell you I'm pretty obtuse. It's not done purposely. I think that I think this is actually part of why central banks are buying more gold. If the U.S. is going to use its massive authority to freeze assets here and there, it's generally positive for the gold market. It might make some actors on the world stage choose gold and maybe choose to hold it outside the U.S. And I'm not making any negative comment on U.S. policy. I'm all for it, generally speaking.
Yep. And another thought on that?
I couldn't make a
Jonathan's
comment on confiscated assets, whether they're going to get them back. But, you know, I do think that the risk of having assets confiscated is something that's probably driving some of the central bank demand right now, because, you know, you don't really own some of the stuff you think you own.
Yep. Okay. Yeah, go on, Abby. Yep.
Yeah, absolutely. I mean, I think you never know with change in leadership what can happen. But for now, they're not getting access to the dollar reserve. That's pretty clear. And I think this is the first time in recent decades where central bank purchases actually exceeded investor purchases in gold. Right. So that's quite a change. You know, over a decade ago, central banks were actually selling gold. It's a completely different environment today. So, you know, maybe people are looking through a period of higher real rates right now. I mean, certainly the chart that Jim showed or any real rates model would show you that there's demand there that normally wouldn't be the case under a real rates model.
Yep. Okay. There's a question over there, and then we'll come down the front here. Sorry, after you.
In view of the green energy, particularly, you know, there is only 2.5% of the electric vehicles right now with the total global market. So there is a complete migration that's going to happen over the next decades from 2% to say 20 or even 30% as ICE goes away. So obviously, with that migration, there will be massive demand for lithium. Now, as we know that 80% or 90% of the lithium is controlled by China. So what is the strategy, or what should be the strategy for more safer jurisdiction for the developed world to sort of diversify or sort of decouple away from China into more favorable jurisdiction to meet this demand?
Yeah, I think we can tackle that in terms of like the amount of
I'm just
processing
going
that
to
China
make
will
a starting
control.
point saying that I know the investment world hates hearing this, but battery demand is more than just lithium. It's lithium, it's nickel, it's cobalt, it's the PG, platinum group metals, and it's definitely copper, even though the Inflation Reduction Act seems to ignore copper as a strategic metal. And you're right, all of these things are going to get driven higher. And the other point, which is a very important point, once again, not just for lithium, but for everything. There was a big conference in Sudbury, Sudbury being Canada's, the nickel capital of Canada, last week. And some of the auto companies were there, and we've got a couple of very large investments in Sudbury that we are quite active in. And one of the auto companies was explaining that even when you look at the nickel market, with the ESG practices of so many places in the world, they can't buy or source nickel from a lot of these places. So they were there in Sudbury because they want to see Sudbury continue to get developed. It's an incredible mining jurisdiction, and anybody who hasn't been to Sudbury should be. But as a city of a couple 100,000 people, they've got great relations with the Native community. They've got great environmental practices. The mayor of Sudbury is very pro-mining. Most of the people in the city have some link to the mining industry, and most of the people that live there are outdoorsy, snowmobile, hunting, fishing, cottage-type people. And it's an incredible example of how mining and the rest of communities can evolve. But as you start coupling ESG requirements on top for lithium, for all of these things on top, there's the demand to develop assets in our part of the world where our practices could be monitored is going to be very high. And I expect at some point we're going to have differential pricing, particularly with nickel, which already has class 1 nickel, which is a shortage, and class 2 nickel, which has a surplus. And you have one nickel price, which has come down a little bit, but there's still a shortage of class 1 nickel.
Interesting, very good. There was a question down here.
Thanks. Two quick ones. One, it's Rob Coloring with AIC Family Office. Audrey, you mentioned artificial intelligence. Could you expand on that as to how you're integrating that? What makes a difference? And then for my old bank colleague, Carl, you mentioned Indonesia and Africa, DRC. Conditions around that, is it government support, is it certain type of customer offtake, cleanliness, that you feel very comfortable on those margins?
Sure. I think it's early days in the natural resources space for AI, but we are seeing companies continuing to try to just reduce costs wherever they can. Whether that's labor is obviously a big cost. So whether it's automated trucks in mines or using better algorithms with AI to help find resources in the ground, whether it's energy resources or metals, analyzing those resources. I think that there's scope for AI to help reduce those costs in the future, but it's early days. I think there's also the economy-wide impact of AI, where all the things we do every day, all the technologies we use, our phones and so forth, maybe those will change. Maybe we use headsets or other things, and search will be disrupted. Things that we take for granted will change. That's just the nature of technology, and ultimately that's how productivity grows, and that's deflationary in a good way. So, and that's something that could maybe help us grow into the debt that we currently have, right? Grow our income to meet that in real terms. So I think it's both. I think it's really an economy-wide phenomenon, and productivity numbers have been really abysmal lately. You could argue that's a hangover from COVID and the very tight labor markets that Jim so colorfully described. But whether it's a short-term or longer-term phenomenon will ultimately depend on or drive whether we have to monetize more of the debt or whether we can actually productively grow our way out of it.
I don't know how you can think that AI is going to find us mines. No disrespect here, but I put 10 geologists on a project and I get 20 opinions. And so AI gives me 25. I mean, it's 24 of them are
Worse
gonna
than
be wrong.
economists.
First, with respect to those more challenging jurisdictions, I would say first, just from our firm's perspective, you only go to those places if there's something really special. So, for example, in the DRC, that is the highest grade tin mine in the world, and following our expansion, it'll also be the largest tin mine in the world. Now, we are very fortunate. We have, as members of our team, folks who this will be the third mine they will have very successfully built there, so they know their way around. But we have had incredible support from the U.S. government, from the UN, government of South Africa is an equity owner. We've had numerous NGOs because this literally to this region is the first time they've had cell service, electricity. We've built school, we've built hospital, they've got roads, infrastructure. So this brings incredible benefits to the region, and that's why that works in this situation. And a very similar situation in Indonesia. But I think, and this reflects back to the question you asked a little while ago, which gets to the heart of this, and you just really mentioned the reserve, but also a lot of the downstream processing is in China as well. Forget about the resource, the processing, even if, is actually in China. And there's a great effort and race among countries to create independent supply chains. The problem is, as Jonathan pointed out, you have ESG concerns on top of that. In many cases, you have sort of conflicting objectives. The easiest example would be metallurgical coal. Well, you can't build a wind turbine, you can't build solar panels without metallurgical coal, but you virtually can't get a project funded or permitted in metallurgical coal because it's cold and people don't understand the difference between steelmaking coal and thermal coal. And so this goes back to the comment I made earlier. All of these challenges, we all know these mines take 10 to 15 years to bring online, is why we see this great sort of train wreck coming, that there were just conflicting objectives that at some point, are just not going to be reconciled. And either you have to slow down the energy transition, or you have to do so, or what's going to happen in the medium term is you're just going to have a price response, right? All of these things, you're just going to have a price response. And that's, again, why we're so constructive.
Yep. Excellent. Well, look, we've only got a few seconds left, unless there's any real burning questions. I think I can, one quickly just from here. Yeah.
This is for actually James. The jewelry market is very important to the price of gold. And under that circumstance, I don't understand how anybody could determine the upcoming price for the jewelry demand, given the fact that we don't know the amount of if the harvest will be good in India or not, since India is the largest buyer of jewelry, and we depend on the farmers to purchase the jewelry as the largest population of people in India. What say you?
It's tough. The margin that you pay in New York is very, very high for jewelry, and therefore relatively price sensitive. It depends on if you're making a living or not. If you're working, whether you'll buy jewelry in the West. In the East, it's much more, in the non-OECD world, it is effectively a question of price. So we do work with a lot of the main jewelers, and we do see price discrimination come in and out at certain price points. Also, in the case of India, the monsoon has has a significant impact. And just to show the length at which your humble HSBC analyst will go, I'm on first name terms with the boys at the Mumbai Weather Service for the past 25, 30 years, tracking the monsoon, because 2/3 of gold jewelry is bought in the rural tribal belt which is a function of the harvest. And so that's how we try to do it. And also, I work with our Indian economists on what we think the income levels will be, as we do with the China economists as well. And we do our best. And just a quick word on, I know my friend who asked the lithium question has left, but I'm keeping a sharp eye on the lithium price because if it goes too high or there is any shortage, medication for half my family is going to be disrupted. So you'll see a lot of odd behavior from people with the last name of Steele running around if there's any real disruption there. So I'm very concerned for what I've heard today.
Yep. Excellent. Okay, well, look, we're out of time, but do grab our panelists if you can for some more questions, and thank you. That's really